Thank you for joining us for our Seaspray Making Waves podcast series. Brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves podcast.
Hello again, and a happy new year to everyone. Welcome back to episode 5 of the Seaspray Making Waves podcast series. The podcast series is available now on YouTube, Apple, and Spotify, and on our website. We would be delighted if you would follow us on LinkedIn and like and share our content from the company page. And just before we begin, just to update you on some of the new initiatives from a marketing point of view that we have undertaken in the last 12 months. As well as this successful podcast series, we have introduced a new series of data insight videos on a range of topics across our products and services. And also, we've launched a new weekly market review, which publishes each Monday and is available for free to download from the website. Both of these initiatives are available for free, as I said, and you can share the content from LinkedIn. Worth a watch, I think, and worth checking those out. So, back to today. We will take a look back in the rearview mirror at what has been really a volatile and challenging 2023. And then we'll take our crystal ball and look ahead at 2024 at the key challenges and opportunities for investors this year. And I'm delighted to help me discuss the highlights today. I'm joined by our 2 regular Seaspray contributors, Paul McGowan, Managing Director of Seaspray Financial Services, and Danny O'Leary, Head of Seaspray Private. Welcome, guys.
Good morning.
And a happy new year to you both.
Yes, to you too.
So, that was some roller coaster of a year. It's hard to know where to start, but I suppose if we take a look back at this time last year at our inaugural podcast and our outlook for 2023, how does the Seaspray scorecard hold up in relation to some of the macroeconomic and market-related calls that we made back then? So how did the calls we made then stack up now, Danny?
It's good and bad. No. Actually, Marty, before I do that, can I just say happy and healthy 2024 to all our viewers and listeners from all the team at Seaspray. It's amazing. 12 months has gone by very, very quickly. But if I could put it in context before we go into the rearview mirror for 23, I might take you back 45 years because that's how long I've been involved in investment markets. So I had a look back to see what has been happening. And when I look back on the world index in December 1978, up to now in terms of December 2023, we had 12 negative years in that 45-year time horizon. But within that time horizon, if we had stayed and done nothing, we were annualized returns of 10.13% per annum.
Okay.
And I just want to put that in the context that we are talking short term. We're talking last year and we're talking what we think about the coming year. But the critical thing for our clients, investors, is that this is a long-term journey. This is about making decisions and planning that will actually affect the next 5, the next 10, and the next 15 and 20 years. So I think we need to put it in context before we start running into,
Sure.
the short-term aspect, very important as they are. But the critical thing is, at Seaspray, the team at Seaspray are there to look after, to plan, advise. We are active. Volatility and all the headwinds that we're going to be talking about, the elections, they're part of the investment journey. Where Seaspray and the team at Seaspray come in is on the basis that we look at that volatility, we look at the headwinds, we look through that, but we look at the opportunities that it presents to provide the long-term gains. And before anything in 2024, I would like to reassure all our viewers and listeners that is about good investment management. It's about good planning and making sure that people, our clients and investors can sleep at night. Absolutely. So I hope just to give that sort of message in terms of the long-term aspect in terms of where we're coming around.
Yeah.
And you're absolutely right. Where's the scorecard for 2023? We got quite a few things right. We had risk on, Paul, right. I think, as the equity markets. And we did say there was going to be the R word, recession. And believe it or not, it wasn't that R word. If I sum up 2023, there's 3 R. One, it was resilient. I think the economy's proved us wrong in terms of the fact that we were looking at recession-type scenarios. I think recovery. 2022 was a very bad year for all asset classes. When I look at equities, when I look at bonds, and when I look at property, it was all negative. We've come off in 2023 from a recovery where we are now seeing world markets over 20%. We're seeing the S&P 500 at 22, 23% in terms of a gain in the last year. And when I look at Europe, and even the Irish ISAC was about 24%, Paul, I think, this year. Yeah. So we have seen very strong double-digit returns. And just to put this in context, 2023, in terms of that recovery, I have to say it goes down to the Magnificent Seven. If you're in any structured solutions or multi-asset funds, if they had the Magnificent Seven, the Microsofts, the Alphabets, the Nvidias, etc., you would have been getting a portfolio that would have rebounded back during 2023. And I think that's an important part of what happened. So it wasn't a massively broad return from equity market. It was a very concentrated. And if you take out that Magnificent Seven in terms of the S&P 500, they accounted for 2/3 of that 22% gain. It's a phenomenal aspect. And that's why, if we look at 2023, back this time last year, when I look back, we were in the middle of the Silicon Valley banking crisis. Correct. There was a bank run.
Yeah.
So when I look at the 3rd R, it's the roller coaster.
Yeah.
The first quarter, we were looking at, banking crisis. We were looking at what's happening. We were looking at the central banks doing a tightening in terms of monetary policy. That was really the speed at which it moved from 0 right up was significant. These were all headwinds as we look through. And yet, going back from September 2022 right up to July of 2023, the markets were on a bull run. They moved from the lows of 2022 to the position in July where we had a bull run of over 20% on both the developed markets that we were looking at.
And I think, Danny, one of the things that is important to look at is you talked about the central banks, that tightening cycle that happened in 2022 flattened in 2023.
Yes.
And we had, as part of our scorecard, we had said we expected the interest rate cycle to change and to start coming down, or at least to flatten out and then start coming off. And what it did do was it gave a drive. In equity markets then started anticipating that interest rates would fall.
Sure.
And that's what gave a really strong push in the last quarter. However, you also saw a big drive in the fixed income market. If you think about it, we had 3 years of negative returns in fixed income. And then in 2023, we finally start to see some positive returns. And that was on our scorecard. We had said that we expected that bonds would actually start to perform in 2023. Yeah. So there's a tick there on that one as well.
Yeah.
I think the other areas, obviously, we had raised an issue with regard to geopolitical risk. And none of us anticipated the awfulness of the Israeli-Gaza situation, which is ongoing. But this is something we're always going to have. We're going to have geopolitical issues. Right into the very end of the year, we had the situation in the Red Sea where you have attacks on shipping. Now, if we remember back in 2022, when that ship got caught in the Suez Canal, and that caused a huge impact on supply channels, which really fed into the inflation situation. That unraveled. But now suddenly we're finding that the biggest shipping companies in the world are starting to move their ships from the Red Sea to going around Africa, which will add a little bit to inflation in the first part of this of 2024.
Right.
But this is an ongoing situation. You're going to have geopolitical issues. And I think what's really been interesting to see is the VIX index, the fear index that we know so well, has been remarkably low. It's sitting down around 12, 13 the whole time. At the peak when COVID hit, at one stage it got up to 60, 70, and then fell off. So down where we are now, it's saying the markets overall are not seeing massive risk in the universe, even though media would have you believe that geopolitical issues are really affecting everything in a bad way.
True. I think for many clients and many of us on the day-to-day scenario, last year was about trying to deal with the cost of living crisis. When we get down to it, when you're seeing electricity bills come in at the height that we were looking at and have never really witnessed before, they were real concerns for consumers in terms of how am I going to manage day to day. And I do think the fiscal approach and the fiscal stance was the right thing to do to get people through that, no more than we did in the pandemic.
Yes.
But I think 2024 will be the year where I think we're now moving along in terms of that. But I think as a fair reflection of 2023, it was resilient. It had a recovery scenario. And I do believe that it's been a challenging, but it's been a positive 2023 overall.
Right, yeah. Well, I think you've neatly brought us on to 2024. I think, there's a balancing act there, I think, throughout the year between stimulus and managing inflationary pressures and what have you. But looking at 2024, we're coming off somewhat of a December bounce, the proverbial Santa rally. The focus will naturally turn to the geopolitical headwinds, or the conflict in the Middle East, as you mentioned, and the plethora of general elections across the globe, really, particularly with the US this year. But having said that, given those uncertainties, there's still great optimism for growth and opportunities for investors during this year. Would that be fair, Danny?
I think, and Paul highlighted this, we are always, when I look back 45 years in terms of negative years and positive years, geopolitical issues have been at the forefront right through that time period. They are going to be part of that investment journey as we go forward. And we have to be able to look through that, and that's when markets do look through that. But it is very worrying at the time. And again, the atrocities and the war in Ukraine and what's happened in Hamas, our hearts go out to the people and the suffering that's going on in that. But the critical thing is that we have to look through that. There will be settlements, or there will be some positive news coming in at some stage, even though it's really tragic where it is at the moment. So I think what we've got to look at is 2024, dealing with that. And you highlighted there's going to be elections like never before in terms of
it's quite incredible, actually. It's the largest number of global elections ever are going to happen in 2024. Over 50% of the population of the world will be voting. And when you look at it, we start in Ireland, we can expect most likely an election probably in May this year. EU elections in June. We have 4 or 5 European countries have their own national elections as well. You have Russia, you have India, you have, and then obviously at the end of the year in November, the US election. And now I see in the last few days, Rishi Sunak has come out in the UK to say that probably on the 14th of November, they will have the UK election. So we're going to by the end of 2024, we're going to be sick of voting and elections. It's part of correct. It happens every 4 or 5 years.
Yes,
just happens this time.
Absolutely. And again, we're going to have to look through that. And when we look at the history in terms of, and we have this in our outlook and for people to look at, when you look at all of the geopolitical issues, the wars, the crises, etc., markets will come through those negative time periods, and likewise with elections. So there is data to back us up in terms of what we're trying to say is that we have got to take the long-term perspective in terms of where can we get value and where can we see opportunities. And for our investors, it's to actually work with us in terms of the planning side of that and the advice side of that in terms of where we are. But I still think the key scenarios is inflation. It's not going to change. We're going to have to get inflation down to the levels where it's at reasonable levels. The target ratio, the 2% target ratio set by the central bank. Price stability from the developed economies such as the US and UK and Europe, they're going to be dominating. So the really good thing that I'm looking at as a sort of why I think 2024 will be better and why we believe that is because we've hit the top of that interest rate cycle. That the turning point is now more in a downward trajectory rather than the upward. That uncertainty as the cost of borrowing and the cost of capital keeps going up, that hurts. Now we have a sort of plateau where we can actually see that the next step if we are comfortable that inflation is moving, and if the central banks are comfortable that long-term inflation is back to the 2 to 3%, you now have the ability to have rate cuts in 2024.
Yeah.
I think that's a massive, massive plus in terms of.
And I think at the moment, like there's particularly if you start with the US, which is the largest global economy, the expectations are anything from 3 to 6 interest rate cuts in 2024. Now, personally, I think 6 is too many, and I don't think that's going to happen, particularly as the inflation still, it hasn't quite got down to the bottom, and early signals are there's still a little bit there, and we already saw that December there was a slight pickup. So I think pressure is going to be kept on that, but I do think probably in the US you're looking at 3 to 4 cuts over the course of the year.
Okay.
And that will help with household incomes. It helps across a whole range of areas, which then helps consumer spending, which will be the pickup. Because if we look in 2023, corporate earnings were extremely strong, driven to a large extent by inflation. Because if you've had your price increases of 8 to 10% and the consumer was still spending, then hits to the bottom line. With inflation coming out of this system, that kick to profits will come off. But then it means the consumer will have more money in their pocket. So you'll probably see a good support into corporate earnings in 2024 by pickup in consumer spending.
And I think the key factor going forward is that the central banks do not need to have recessions to control inflation.
No,
I think that's a key message that I think for 2024 is very, very important. And we're coming through a very resilient 2023 where employment levels have been and remained very buoyant in all of the histories I've looked at. When we're looking at interest rates,
we're at all-time low in unemployment
very
rates.
strong.
Yeah.
So
At a time of peak inflation, like there's the famous Phillips curve, which compares one against the other, which historically would have pointed to that as inflation went up, unemployment rates rise and the whole thing. That didn't happen. In fact, the opposite has happened. So it shows the management of economies by central banks has been very, very fine-tuning.
Yes,
it's been tough, but I think it's the right, we've taken the pain.
Yes.
I think there's a lot in the growth. I think we're of a view that world growth next year will be slower, and the trajectory has been slow in the last while. But if you can get a 2.5% growth rate, which is, I call, a soft landing. That scenario will be very, very important as we move through to 2025. And I think our base case would be a soft landing in terms of we get some growth in terms of the United States, we get some growth from Europe. It may be benign, but it's not going into that recessionary track. And I think that's where we actually see 2024 coming through in terms of a sort of a worldwide growth scenario in around that 2.5% scenario.
Yeah, it goes back to that, and it certainly supports that mantra that we've mentioned before. Give it time, be patient, and diversify.
The key message from today, with everything we're saying about markets, is that there's going to be opportunities. And we'll highlight those in a few minutes. But the key is time. It's not about speculating. It's about having time and making those decisions that can take us out over the next 3, 4, 5, 10 years. And that's where we come in. We deal with the volatility. We look at being active and agile to actually spot those times when volatility is there, that we can actually get very strong value to add to our portfolio. So we can actually create better risk-adjusted portfolios for clients.
And I think, Danny, sorry, just coming in on you there, the risk, you use the word risk. And, this is very important that people and clients realize we focus on what the client's attitude to risk is firstly. And that's the constant message we look at. So we do a detailed analysis with clients of their attitude to risk. And out of that, then, we will pick an allocations into markets that match that risk. So there is the risk of what can go on in markets, but there is what the client risk is. And we look to combine both of those always. And that's where in the year ahead, a low risk client might not have a huge exposure initially to equities, because at the moment, our house view is that if interest rates are going to fall anything from 3 to 4 times over the course of the year, well, then fixed income is going to be the one that's going to push on forward.
The bond market should act positively as rates coming down, prices should be supported.
Right.
But I do believe that we're still looking at 10-year yields at the moment in the US, 3.94.
Yes.
We're still looking at German 10-year yields just over 2.
Yeah, 2.17 this morning. And
when we're talking
Irish
about
rates
inflation,
2.45.
Inflation at 3, you know.
Yeah.
Where is your value? We've got to use them as supporting and defense mechanisms, and they have that position in the portfolio. But you have to look at the growth side of it as well. So it's using that mix in terms of, asset allocation is very important. And diversification, you mentioned it, diversification.
Exactly. Well, there's plenty of fodder there for our viewers and listeners to get their teeth into. Very insightful, guys. And if I could just bring it back for a minute, Paul, to the domestic economy. Our macro numbers here are still very positive.
Yes.
And we ourselves have, as you mentioned, a looming election either back end of this year or early next. Where are the growth prospects in Ireland, do you feel?
Well, I suppose the first thing is the forecast for economic GDP growth is actually coming in around 3% for this year, which is a pickup from 2023 was minus 0.9% at the end of the year. So we've actually had a slowdown. But a lot of it was also driven by what's happened in our tax receipts. There was some uncertainty during the course of the year 2023 when we saw a fall off in tax receipts, in corporate tax receipts. But it turned out in the last quarter that it had actually been reversed. It was all related to pharmaceuticals.
Right.
So if you look at the big drivers of corporate receipts and the big drivers of the economy in Ireland are obviously the technology companies, financial services and pharmaceuticals. All of those are now on track and performing well. We're seeing new players coming into the Irish market. A great example we were only talking about the other day, Novo Nordisk, which is the company that has this weight loss drug, which technically was a diabetes drug that now people have realised you can drop 10, 15% weight if you're taking it. They're opening a big plant in Ireland. Danny, do you want to give the details?
The planning is in there for, I think, West Dublin, Clondalkin.
Okay.
But it's going to be a 2 billion investment, and it's going to bring manufacturing, probably the creation of about over 1,000 jobs, Paul, in terms of that. And again, this is a company that many might not be familiar with, but in terms of the worldwide demand now for diabetes, stroke, weight loss drugs is phenomenal, and they are struggling for demand in terms of production, and they're looking at Ireland now as a key area in terms of the production and the manufacturing. So that tells us we have good people, we have good skills, and we have the ability in terms of being able to be positioned as part of Europe to be able to be a very strong player in getting that manufacturing element back into that. So I think that's going to be a real plus for the economy going forward. Novo Nordisk, they have now become larger than the luxury goods company LVMH in terms of value, in terms of Europe. They're the top company in Europe. The largest company in Europe.
At this moment in time. But we'll discuss this as part of our, what do we like later in the session. But it goes to reflect Ireland has always been a country perceived as a good place to have pharmaceutical companies. We still have all of the major companies that were here previously are still here manufacturing. They are realigning some of their areas of output, but they, like with COVID gone, well, it's not gone, but the demand for COVID vaccines has fallen off. But there are other areas that are picking up.
I think 2024 for Ireland will be that we solidify what's been happening in 2023. We're moving in the right direction in terms of, I think growth will be around that 3% in terms of 2024. Employment is still very, very strong. So consumer and income is still coming in there. We've still got to get through the cost of living, but a crisis and I'm seeing inflation numbers moving down to that 3% trajectory during the year. So they're all positive signs that we can actually be another key player in terms of European growth.
Yeah, I think what's really important is the unemployment versus employment. Unemployment rate is around 3.8, 3.9%. That's effectively full employment. In an economy that has actually grown the number of people who've come into the state by over 500,000 people in the last 7 to 8 years. We have the highest number of people employed in the history of the state. So you've got good, strong income earning situation going on, and you have consumers who have funds to be able to invest and buy things. If interest rates start to fall, like the 10-year Irish bond rate is sitting at 2.45%. Mortgage rates are going to start coming down this year, which will ease the cost of living for people, and I think that will help to be a driver within the Irish economy. The big one then is the politics. And as I said, expectations May this year, we'll have a general election. It'll be really important.
This year or?
In 2024. But we have to have an election by March 2025.
Next year, yeah.
But from what I'm hearing, the expectations are that you could, around May might be the right time, particularly of what's coming out in polls and how things are going. The government are looking very carefully. It's all linked into to how the view is on housing, what's happening, what's coming on stream, what's available for people out there. And if interest rates are starting to come down and if inflation is under control, it may be the right time for them.
My view, it'll be Q4. I think.
There we go.
I think they'll want to see how it develops. But that'll be an interesting debate as we go forward. Yes. Absolutely.
I'm going to just push us along a little bit, guys, because we could talk about Ireland a lot. We're obviously still an attractive little island for FDI, that's for sure. So just on client portfolios, Paul, just what would be the key stocks that you would put on a watch list? I know you mentioned technology stocks and healthcare. Are they still going to feature strongly?
Oh, most definitely. I think in 2024, what we will, and what people are going to have to do is firstly the disruptive technologies. So AI, we saw, none of us knew of ChatGPT a year and a bit ago. Now you have about 4 or 5 different alternatives that are being used. Every second ad on the social media is to do with new ways of integrating artificial intelligence into your business. And there is the alternative being either going to wipe out certain areas of business or going to enhance businesses. But change is here, and it is large. So we will be looking within portfolios. You have to have an element to this. It's like when the internet came along, and those who started buying stocks, the Amazons of this world at the start, were the ones who benefited the most. Now, like the big players in this area include things like Nvidia, Microsoft, Amazon, Meta, Palo Alto Networks, C3.ai, to name a number. Like if you did a basket of those stocks and include them in your portfolio, or look for an ETF that includes those, that will give you got good exposure. At the same time, obviously, we were talking about the weight loss drugs. There are a number of these. The market they're estimating by 2030 will be over $100 billion. Already, I know I was in the States over Christmas, and there are ads running. Almost every second ad is about weight loss drugs. And, America and New Zealand, the only countries in the world that can have pharmaceutical companies advertising to consumers. And it is just nonstop. And it is the discussion of anybody you meet there. They're all looking to do it. So I think investing in companies that are in that area, which includes obviously Novo Nordisk and Eli Lilly are the 2 leaders at the moment. But there's companies like Viking Therapeutics, Structure Therapeutics, Pfizer and Amgen. They're all looking to build into this. It'll be very interesting to see actually if the likes of Pfizer reposition some of their operations in Ireland into looking at this area.
True. Yeah.
So I think having exposure into those is very important. And then obviously we'll talk about a couple of specific stocks at the end, but they will be definitely areas you have to have. And where you combine the AI with what was the Magnificent Seven, if you can link those up, there will be some opportunities.
It's an interesting scenario. Just when we were talking about the Microsoft's, the first time in 30 years, they are now going to change for Windows 11 the keyboard, and it will have an AI assistant, another button on the laptop.
Wow.
On the keyboard, sorry. So when we're looking forward in 2024, part of the AI and coming through it and bringing people with the sort of focus on AI. There will be an AI assistant on the keyboard, Copilot, I think it's called.
Right, okay.
And that's going to be a significant development to actually help people along the journey in terms of the benefits that AI can do, no matter what business we're in. We see advantages. It is probably a key growth theme for us in terms of 2024, along with climate and along with circular economy, which I mentioned. But critically, when you look at the top companies like Microsoft, they're generating revenue of about $2 billion a week. Now, that's a significant amount of cash with no debt. You're looking at companies that have got that capacity to embrace the challenges and the disruptive technologies, but be at the forefront of that. And you don't have to take the major risks of going into companies that are unknown. So I think it's that combination of making sure that we are with the well-capitalized companies and making sure that they are part of that portfolio structure for clients.
Well, you mentioned key growth investment themes there, Danny. What's the house view on those, given the in-house experience that Seaspray has demonstrated and the success of our structured solutions in recent times?
I'm glad you asked that, Marty. I think the critical thing is that we look at themes over the long term. And over the last number of weeks, we've had a number of maturities. One was on an EMU, circular economy solution, which was over 2.5 years. It produced 25%, 10% per annum.
Okay.
And that kicked out. But it kicked out on the basis that even the markets over that 2.5 years, and we spoke about this, have not really moved that much over that period of time. But this is part of creating investment solutions. And that's what our clients are looking at us for, to be agile and to be able to be nimble in terms of pricing. So circular economy is still a very, very strong aspect in terms of that. The other aspect in terms of where we are is what we've mentioned, AI. AI is going to be a significant if you like, generator of revenues over the next 10 years, out over the next 10 years. Alongside the circular economy, we see a 4 trillion. We're looking at probably 2 trillion in terms of the growth estimates in terms of AI. So those are two key themes that we would have. And the other scenario in terms of technology, we've just had a kick out on a global technology that we did 18 months ago, which produced just 19.5% over the 18 months, which is about 13% per annum, Marty. So these are the types of structures that as part of your overall portfolio, we can create and we can put that as part of the asset allocation in terms of that. But again, I emphasize, these are medium to long-term strategies. If they kick out after 2.5 or 3.5 or 4, you are looking at rolling time periods over the next 10 years as part of your portfolio. The other key theme, I think, and I heard it this morning on the radio, climate and climate change is so important. We had the hottest 2023. I know it doesn't feel like that this morning in the cold, but it was the hottest 2023. And that has major implications, in terms of the planet, in terms of where we see things, in terms of doing the right thing for the planet. Climate change is very, very firmly fixed as an integral part of our philosophy, and it's about sustainable and responsible investing. And I think climate change is going to be a key theme as we go forward. Okay. So just to put this in context, if you look at Ireland in 2024, and nobody's probably even mentioned or heard of this at the moment, there's going to be a deposit return scheme. There's 40 countries involved in that. The deposit return scheme, we are very good in Ireland. We recycle between plastic and aluminium cans. We recycle about 65% of that. But 35% of that is still waste. It's still littering our streets. The deposit return scheme is where you have the producers, the retailers, and the consumers all acting in a circular manner to actually reuse and recycle. So what you're now going to have on the 1st of February is a deposit return scheme in most shops, retail outlets, where you put a value on that plastic bottle or that aluminium can, and you can get that back and bring it back to the retailer. And the critical thing is that you will get rewarded for that. So even if you're picking undamaged ones up off the street or whatever, you can bring them back into a retailer and they have a monetary value. Now, in Denmark, the Danes have got recycling up to 95%. I think that's a huge goal that we can now in Ireland, as a nation, I think we should be embracing that as part of the circular economy story that we have.
Very interesting, Danny. And that circular economy topic is one that you mentioned our bond, and I know that for more detail, if people are interested in looking at that, they can look at our maturities page on the website.
It's on our website, and the technology one.
And there's a video inside dedicated to the circular economy as well. So that's there to view.
And if I dare mention IKEA, if I can, on the circular economy, I know between Christmas and everything, we're buying the furniture and everything, but IKEA, 32 million products in IKEA circular hubs were resold last. It's phenomenal what they're doing in terms of moving into. So any bit of furniture that you and I buy now, we can take back. It's a sale and take back. You can take it back and get a monetary value. They can fix a lot of the stuff in terms of the products, and they can refurbish it and bring it back on as second-hand furniture, etc. But we're getting into that where from a consumer and from the producer, we are now moving very strongly into that circular. We can continue to use the chairs. We can continue to use the beds once they're fixed and refurbished. We are getting back into that situation where we're not throwaway. And I think as a nation, we've got to embrace that.
That's true.
And I think we're going to see that more and more. And my view is that 4 trillion economy is going to be a really strong growth theme as we go forward.
Well, that's definitely quite clear from what you've just said. We've got one question from our clients, and I think maybe I'll address this to you, Paul. The question is, given the potential for rate cuts, do you see growth in commercial property investment in the coming year?
Yeah, commercial property has been very interesting. Obviously, higher interest rates really affected the sector. Asset values have fallen. And in fact, in 2023 was the lowest period of time when you had private investment into the commercial market since 2017. If you look at the market's striated a little bit. So in the office sector, A-rated high-end offices actually performed well, and there was reasonably good take-up. However, the lower end of the market, we saw a fall-off in values and a fall-off in demand. The retail end of the market, high-end retail seems to have held up quite well. But what's happened is in regional retail and in shopping centres, yields have had to blow out in order to keep demand. There is still an issue with regard to that shift that happened to online shopping. Though I think there's more and more people gone back to high street purchases, rather than people like the interaction with other people in shops. And that's what's been seen. In 2024, as interest rates start to fall, definitely opportunities are starting to open up, and value in the office sector in particular is starting to open up. We are seeing the return to offices. You can see it in the cities where towns, the roads are getting more packed. There's a lot of people traveling and into work again. So most companies are now back at least 2 days to 3 days a week. And in many sectors, people are starting to, particularly the services industries, they've realized that the younger employees are not getting the benefit of the experience of older employees, and they need that within a service industry. So they're forcing people back into offices, which is going to help the sector. There is an issue that because of the interest rate hikes and because of what happened in the sector, there is a fall off in speculative construction. So the demand is going to be squeezed. Also, the other side is that with the demand for housing, there's been a lot of repurposing of older office space. And this is an ongoing thing. And the combination of, we have 120,000 immigrants have come into the country in the last 12 months. The demand for housing for them, and there is a kind of, you can see it around, particularly in Dublin, there's been a number of blocks that have been taken and are being repositioned for immigrant housing. This takes stock out of the market. So yes, I think 2024 will be a place to invest in office investment, in commercial investment.
So that's a very, very positive message, Paul. Thanks very much.
It's definitely been a tough 2 or 3 years in terms of the property, but that's not alone in Ireland. It's been across Europe. I agree with Paul. I think the fact that interest rates are moving down and long term, when I look at 10-year yields in terms of 2% and 3%, you're going to see the valuations on properties moving in a more positive direction.
Right.
Yeah. But it's very, very important to realize that if you're in good office locations and you have got strong rental income coming in, the rental income, even though the valuations have been fluctuating, that rental income forms part of the accrual in total. So it's, we've got to make sure, again, I keep saying this, we've got to come through the cycles.
Yeah.
And by that, I mean in terms of the property market, which has suffered from a valuation perspective, that's going to, I think, turn as we see interest rates moving down over the next 12, 18 months.
Yeah, and that directly links in with the banks, because with interest rates have gone up so much, the banks rapidly sort of push the cost of borrowing up. As the interest rate cycle changes, they will start to loosen, which will then encourage investment in the sector and encourage new construction, etc. And that's a big driver as
Brilliant.
well.
Super stuff, guys. I'm afraid time has caught up with us yet again. So unfortunately, the half hour goes very quickly. So to Paul and Danny, thank you both for helping us get into the new year. Your insight is excellent as always. So thanks very much. Much appreciated. Cheers. To read more detail about the discussion today, you can download our 2024 Outlook for free from the website, and you can follow our content on LinkedIn. Also available from the website is our full suite of market updates, which is available for free subscription from the website and from our LinkedIn page. And just to mention that the weekly market review that we mentioned earlier is available on the RTE.ie business pages on the broker reports page. So thanks for watching. We'll see you next time and hope you have a great 2024. And bye for now.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Private Limited, trading as Seaspray Private, is regulated by the Central Bank of Ireland. Seaspray Financial Services Limited, trading as Seaspray Mortgages, is regulated by the Central Bank of Ireland. Thank you.